Markets oscillate. We don't go very far yesterday, a little bit down. We don't go very far today, a little bit up. And we're basically still stuck where we've left Wall Street last Friday with that blowout of a jobs report. But things get exciting from here because now we are finally going to get some real meaty economic news to chew on and push things one way or another. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to do here is take a look at the first bit of weighty event risk in front of us here, minutes from September's fateful FOMC monetary policy announcement, and see if perhaps the markets got it all wrong when they interpreted what the Fed had to say. We are going to unpack here why these minutes might be market moving, considering, of course, we've had quite a bit happen since September the 18th when the Fed convened. So isn't this backward looking? Spoiler alert, no. And see if we can't figure out what might be the reaction function in markets, and then circle around to what is setting up as a trading opportunity here, perhaps in markets that you can consider an actionable setup. So let's begin here with first and foremost a sense of where the meat in that policy outcome came, and so what is likely to be on display in these minutes. So the main issue here, not surprisingly, the outlook for rates. And we can see here that when the Fed delivers its announcement, it basically endorses exactly what is priced into Fed funds futures at the time. We can see here there's a radical readjustment in expectations. So in June, the markets thought rates were going to come down from a median Fed funds rate of 5.3 to 5.1. That's a single cut. Look at the change in the estimate for September, 4.4. From 5.33, that median, to 4.4 is basically 4 cuts, 100 basis points, give or take. Of course, in September, the Fed issues 50 basis points of those 100 basis points, and so we have 50 basis points left. We have a pair of meetings left, November and December. So the implications here are that the Fed is going to cut rates by at least 25 basis points in November and then again in December. For the subsequent year, for 2025, another 100 basis points in the offing from 4.4 to 3.4. Now, we have here a near match of what the markets had. They were looking for something like 125 basis points, 5 cuts rather than 4. That's nevertheless very, very close, considering we're looking out all the way to the end of next year. A single cut is well within the range of acceptable adjustment. So we have here what looks like the Fed giving the markets a Goldilocks set of expectations. You'll also notice that I've color-coded them green and orange here, and that's not by accident. Because when you look at the Fed's often maligned, but in this case very useful, dot plot chart that actually shows how the voting distilled into those numbers, you see a very interesting dispersion for next year's outlook, while you get significant conviction for this year's outlook. Almost everybody on the Fed thinks we are going to get at least within striking distance of these numbers. So here's, as we said here, here's 4.4. So that's right about here. And you can see that almost all of the Fed voting officialdom here is clustered in this area. So there's a lot of conviction. The markets echo this. This is the likelihood of what's going to happen over these next meetings. And we can see that by December's meeting, there is a 78.3% chance baked into Fed funds futures that we will have had 2 rate cuts. So we can see here the current target range is 475 to 500. The expectation is we're down 50 basis points from 475 to 425, from 500 to 450 by the end of the year, by the year's final meeting. So the markets overwhelmingly agree with Fed officialdom. We're going to get 50 basis points more in cuts. Something radical would have to happen to change that. That means this is not the object of speculation. Not very much to speculate on. Everybody seems to be generally agreed. The larger issue is here. Now, again, here's 3.4. This is what the median is. But the dispersion of opinions, as we can see here, is much wider. Here is the consensus on the actual number. So 3.25 to 3.5 would be right here. 3.4 would fall right there. That's only 6 officials. 6 out of 19. That's not even 40%. It's in the mid-30s. Not exactly consensus. So the markets are moving as though we have the Fed endorsing market pricing, but actually there's quite a bit of difference of opinion that's implied here. In fact, if we wind this out and said, you know what, let's give this some wiggle room of 50 basis points and say, okay, well, most of them are here. That's a plurality, sure, 12 out of 19, about 63% or so. But that 25 basis points extra makes a huge difference, even if we just look at what's happened in markets so far. Now, consider, ever since the Fed made this announcement, and even a bit before it, because of course the markets were overwhelmingly positioned for what the Fed did, what do we find? The markets were aiming for reflation, and we see that from the beginning of September here, before we even get into the policy announcement, which occurs somewhere around here. The measures of inflation baked into the bond market rising. 5-year, 10-year, even the 20-year. Although, of course, for these metrics, it's a little bit more dramatic, shorter term. But we can clearly see the bond market is saying that what the Fed is about to do is going to bring inflation higher. We can see it in the markets when we see that the yield curve steepened. This is the 10 to 2 yield spread. And we can see that the lion's share of this steepening is occurring. Why? Because the long end is going higher. As if to say what the Fed is about to do is going to mean higher rates in the future because it'll be inflationary. This is not cutting rates for an economy where demand and therefore pricing power are retreating. This is an economy that's doing reasonably fine, and you're adding stimulus on top. That's going to be inflationary. In fact, the most recent flattening of the curve here, modest though it is, has been because front-end yields have also gone up, and they've gone up faster in the most recent version of this. Gold, the sort of natural foil in this environment, it goes higher because the markets anticipate that the Fed is easing in a way that will be inflationary downwind. Now, we get a little bit of a head change in Fed signaling around all of this last week. When Fed Chair Powell was asked after September's meeting at the press conference, well, how should we think about where rates are going next? If memory serves, Steve Leisman of CNBC asked the question. Powell kind of shrugged and deadpanned, well, just look at the summary of economic projections and start there. Well, seemingly that was aimed at this number, where there's much more conviction, and probably less so at this number, because the tone last week became a lot more circumspect. Powell came out and said, our risks are balanced, we're not in a hurry, we don't need to rush into these cuts, and subsequent commentary from other Fed officials sort of echoed this idea. And of course, last week saw a substantial heating up of U.S. economic data. We talked about this in granular detail on yesterday's show, which we'll link here if you're watching on YouTube, just above my head. And what you will see is that we had a blowout ISM service sector index. That's, of course, the biggest sector of the economy, the biggest employer in the economy by far. Strong pickups in economic activity, in new orders, in the inflation index there. And then the following day, a blowout U.S. jobs report, many more jobs created than expected. And lest you attempt to diminish those results by saying, these things are always revised down, well, this particular report, the preceding 2 months were revised up. So anyway you slice it, this was a very positive jobs report, so much so that looking at this City Economic Surprise Index, we find ourselves now at the highest levels in essentially 5 months. Now, what does this mean? Well, we can see that from mid-April onward, U.S. economic data was deteriorating, and by the beginning of May, got to a point where we got under zero on this index, which means we're tending to surprise on the downside. That has been reversed. Now, for the first time in 5 months, U.S. economic data is tending to beat expectations on the whole, which of course suggests that the markets are more pessimistic in their assessment of the economy than reality is validating. Look at the response that this has had on rates, and then of course extend what that's meant for markets. So here's the Fed cut right here. So obviously there's a level change in how much more easing we are expecting to see. This orange line is total easing between this year and next. In the gray is 2024. In the yellow is 2025. Note what happens here. Here's the Fed cut. So we move by 50 basis points. The tally naturally ends up here. And these inflationary moves here, this idea that what the Fed is doing is stoking reflation, that begins to push us a little bit higher here after the Fed move. And of course, last week that move accelerates significantly, such that we go from about 160 basis points in cumulative cuts right here. There's 150, we're just under at about 160. With the benefit of NFP and ISM data, now we're at about 130. So we have a move of about 1 cut's worth. A 25 basis point cut is a standard size cut. We have a little bit more here. But we've moved about the equivalent of a single cut. Look at the violence of the response in markets. Dramatic rise in the 10-year. Dramatic rise in the 2-year. In fact, this gave us this meager 25 basis point adjustment. In the outlook, 25, 30, let's say, depending on when you take a snapshot. 31, if you want to look exactly week on week. That gives us the biggest bond rally in 2 years last week. So a very small change, and we have significant differences in outcome. Which is to say, yes, you could say, well, most of them are within 50 basis points, but that's a big difference, 25 basis points here or 25 basis points there, when it comes to market action. We furthermore see that what this has done is it's put the brakes on stock markets. Because all of a sudden, the dovish autopilot speculation that was out there before suddenly doesn't look like it makes sense. And so things have pulled back. Now, that's what makes these Fed minutes so interesting. This is an editorialized, narrative kind of document, by which we mean this is not a stenographer's typeout of what the Fed did at the meeting September 17th into the 18th. So what we have is much more open to taking in information that's come in since the meeting, because, of course, the Fed knows very well that the markets are looking at this document as forward guidance. And so to the extent that they can shape the way that this conversation is presented and the way that the narrative is formed, the Fed is able to send a signal to the markets, and indeed they're waiting for it. And if that signal suggests that the Fed is not nearly in the kind of hurry that the markets might have thought, and if the conversation even in September suggests, we're not looking to cut with reckless abandon here, well, then the response might look something like this, which is, of course, the adjustment we saw last week. Stronger dollar against the major currencies, and, of course, against Bitcoin. No surprise there. Stock markets barely eked out any gains, and that's the fourth consecutive week of slowdown in their upward progression. They might finally start to roll over. Maybe still higher yields. But the really interesting thing here has been the geopolitical overlay. Because one thing you have not seen, perhaps until now, is a response from gold, which should be getting battered by a stronger dollar and higher yields. It yields nothing, and it's not much of a necessary alternative store of value when its antagonist, fiat, is actually rising. And the dollar, of course, the quintessential fiat currency. So that gold was not able to make hay of much of this, but crude oil was surging, suggests maybe a geopolitical overlay with the hotting up of the issue in the Middle East, the conflict between Israel and Hezbollah as an outgrowth of the Israel-Hamas war. But now, maybe we get some room for catch-up, as we got some headlines today suggesting Hezbollah wants to put a ceasefire out there after the beating that they've taken. Gold has taken a leg lower and has taken out its immediate support level here, about 26.46, 26.50, suggesting it's setting a lower low and might be rolling over. So there's some room to catch up here if these minutes suggest that indeed the Fed is not as dovish as met the eye, and you do get a further nudge up in yields and the dollar. Now gold appears responsive and also late. Because, of course, the markets did everything they did last week in the dollar and bonds while gold was idling. Ostensibly because geopolitical risk was giving it some level of support, as might be implied by this 9% surge in crude. If that's now fading, and a violent reversal in crude today certainly seems to suggest as much, then we could have some catch-up losses here in gold, even just to reflect the pain that was inflicted on the dovish Fed idea last week, and the bond rally and dollar rally that happened then. And then we might have room for some more forward-looking gold selling. So there might be some room here to come in. Initial support around the 2600 figure might give way relatively quickly. It looks somewhat flimsy here. The next important level, this former range top at 2570. Then after that, this larger range top in the 2516 to 24-ish area, former resistance become support. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what may follow. I'm back with Chris on Fridays for Futures Power Hour, on with Victor Jones for the Price of Truth on Wednesdays. That's tomorrow. Back with Victor for the first call at the open of the week with Tom as well. That's on Sundays here in the U.S., writing for the news and insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. As ever, if you're watching this on YouTube, like and subscribe. And Macro Money will be back tomorrow. Happy trading.